Part 2. Unlock the power of supply and demand zones. Please take a moment to pause and read the disclaimer. Here is a mini course overview and the topics I will be covering. Part 1. Mastering market structure. Part 2. Supply and demand concepts. Part 3. Trade execution and liquidity. Part 4. Risk management. Part 5. Psychology and journaling for trading. And Part 6, where we will be putting it all together. So I've set out some learning objectives for this lesson. We're going to look and understand what is supply and demand. We're going to identify key components of supply and demand trading. We're going to identify and draw supply and demand zones. And we're going to look at some mistakes to avoid. Supply and demand, a simple understanding. What is supply and demand? Supply and demand in trading refers to the amount of currency that traders are willing to buy and sell at a particular price. Supply refers to the amount of currency that sellers are willing to sell at a particular price. And demand refers to the amount of currency that buyers are willing to buy at a particular price. When demand is high and supply is low, prices tend to rise. When supply is high and demand is low, prices tend to fall. So supply and demand zones are areas on a price chart where there's potential trading opportunities. Nothing is a given in this game, so it's important to recognize this. It's about finding potential opportunity. Understanding the price cycle. So the price cycle is a pattern that occurs in the financial markets as a result of interplay between supply and demand. The price cycle is the movement of prices from high to low and back to high again over time. There are 4 stages of the price cycle: accumulation, expansion, distribution, and retracement. Accumulation, when participants buy shares from retail investors who are selling. Expansion, when prices begin to rise as participants continue to buy and the retail investors start to buy in. Distribution, when participants start selling share to retail investors who are still buying in, causing prices to stall or decline. Retracement, when prices begin to fall as retail investors start to sell and participants exit their positions. By understanding the price cycle, traders can identify which stage of the market is in and make a more informed trading decision. Remember, it's about having an edge. So here we can see price is going through an accumulation phase, where from the accumulation it'll start to expand, so we hit the expansion phase. Once we fully expanded, price will start to distribute, so we hit the distribution phase, and from here we can see that we enter retracement, so we're entering the retracement phase. And at the end of the retracement phase, we will typically start to accumulate again, and the price cycle happens all over again. Key components of supply and demand, building an understanding for a solid foundation. Supply and demand key components. So we're going to look at a couple of items: market structure, order flow, market efficiency, order blocks, volume, liquidity, zoning, and timing. These are areas that we will touch on and are simply designed to give you a basic foundation, but a prompt for further research and to educate yourself on. Maybe down the line I can provide more detailed lessons if there was demand for it. Market structure refers to the organization and behavior of the market, including the number and size of buyers and sellers. Understanding market structure can help traders and investors identify potential opportunities and risks and adjust their strategies accordingly. If you haven't already done so, refer to part 1 of this mini-series for a whole breakdown on market structure. Order flow. Order flow is the study of real-time orders market participants place. In other words, order flow analysis allows you to see how market participants are trading. Are they buying or selling? Order flow analysis can provide insights into the supply and demand dynamics of the market, which are the core principles of supply and demand trading. By analyzing order flow, traders can identify areas where buyers or sellers are accumulating or distributing their positions, which can be used as potential supply or demand zones for trading. Order flow can also help traders to determine the strength of supply and demand at a particular level by looking at the volume and the speed of the orders being placed. Supply and demand traders often use order flow indicators or tools to help them identify potential trading opportunities based on order flow analysis. Order flow trading can also be referred to as tape reading or order flow analysis. Here we can see a typical order flow chart. It shows you exactly how many buys and sells were executed at each price level. You can also use what's called footprint charts. Now, these can be very difficult to read for a beginner, but what a footprint chart does is it shows us how aggressive are the buyers and sellers. I use market structure to follow the order flow supported by volume. However, if you do want to deep dive into order flow analysis, I recommend reading the order flow guide by Trading Strategy Guides. You can refer to the reference for the link. Market efficiency. Market efficiency refers to a degree to which market prices reflect all available information about an asset, such as currency pair in the Forex market. In a perfectly efficient market, prices immediately and fully reflect all available information, leaving no room for profitable trading strategies based on past price movements. However, in realities, markets are not perfectly efficient and there can be temporary market inefficiencies, also known as imbalance, which can create trading opportunities. Supply and demand trading strategies are based on identifying these market inefficiencies or imbalances, such as areas of significant supply or demand zones where buying and selling pressure occurs. By identifying these areas of supply and demand imbalances, traders can look for potential trading opportunities based on price action signals that suggest a potential price reversal. Efficient versus inefficient. Efficient price action implies that the asset's price accurately reflects its intrinsic value, minimizing the occurrence of mispricing or significant deviations. What this simply means is that wicks will meet on either side of a candle. As you can see from the graphic, there's 3 candles, and the middle candle, the wick on either side is crossing or meeting. Inefficient price action occurs when there is a delay or incomplete adjustment of an asset's price in response to new information, leading to a temporary imbalance between supply and demand. What this simply means is the wicks don't meet on either side. You can see from the graphic the 3 candles again, but you can see the wicks on either side are not meeting. Traders use a rule of thumb that price will always return to fill in the imbalance. However, in my experience, this isn't always the case and historic imbalance can fail, so don't rely on this as a given. Order blocks. Order blocks are where significant purchasing or selling activity occurs on a chart. These areas represent zones of liquidity where large orders have been executed, creating a price level that is likely to attract future market participants. In supply and demand trading, order blocks can serve as important levels of support and resistance and can provide valuable information about a market sentiment and potential market direction. Order blocks can be identified using various techniques including price action analysis, volume analysis, and order flow analysis. By recognizing and analyzing order blocks, traders can better understand the underlying market dynamics and make a more informed trading decision. Now let's look at how we can mark up an order block. So we can see from the structure, we've had an upside breakup structure, which has produced a swing low for us, and we can identify a lot of imbalance. So at this point, let's look at it in a bit more detail. So it's exactly the counter trend candle is where I draw my zone from, before the move that causes the imbalance. Now, using the exact same example that we've just used, let's play out how the market actually fared out in this instance. So as we can see, price action continues and eventually our order block gets mitigated before price action continues to move to the upside. It's important to recognize that this is obviously a back-tested scenario where I could demonstrate the example. It's not always as clear-cut and not always as easy as just identifying an order block and guaranteeing a trade. There is a lot that goes into creating a confluence list, and it needs to be aligned with your trading strategy to make sure that everything is ticked off to confirm that your trading entry is done so on the basis of an informed decision and that you have a rationale behind why you're entering. You're not just entering a market blindly or finding an order block example and hoping for the best. Volume. Volume represents the total number of transactions in a particular market over a given period of time. It is a key indicator for market activity and provides important clues about strength of supply and demand at different price levels. Volume analysis can help traders identify key supply and demand zones based on the volume profile of the market. High volume at a particular price level indicates strong interest from buyers or sellers. Conversely, low volume at a particular price level may indicate that a zone is less significant and may be more easily breached by price movements in the future. Overall, including volume analysis into your supply and demand trading strategy can help you make more informed decisions based on the underlying market dynamic. High volume in the initial zone could indicate that there is a strong selling or buying pressure in that area. However, it is important to consider in the context of the overall market and to analyse market structure, price action and volume together. Just because there was high volume in the area where price action previously sold or bought from does not necessarily mean that the same level of selling or buying pressure will occur again from that area or zone. It's important to use multiple factors in making trading decisions and not rely solely on a single indicator or a signal. It's all about building a confluence list, and volume can play a very important part, but don't rely on volume alone. Liquidity. In supply and demand trading, liquidity is important because it affects the speed and ease which a trader can enter and exit a trade. Areas of high liquidity tend to be found near key supply and demand zones and in the vicinity of major news or economic data releases. Traders often look for high liquidity when placing their trades, allowing them to enter and exit the market quickly and at a fair price. However, it's important to note that high liquidity can also attract large market players, which can cause price volatility and slippage. As such, traders should always use risk management tools to protect themselves from sudden market moves. Zoning. Zoning is identifying and drawing supply and demand zones on a price chart. In supply and demand trading, identifying zones is crucial for finding high probability trading opportunities. A supply zone is an area on a chart where sellers are likely to enter the market in large numbers, causing a reversal in price action, i.e. selling. A demand zone, on the other hand, is an area on the chart where buyers are likely to enter the market in large numbers, causing a reversal in the price action, i.e. buying. Zoning involves identifying these key areas of potential buying and selling pressure based on previous price action and order flow. Once zones are identified, traders can use them to make trading decisions such as entering and exiting positions, setting stop losses, and taking profits. Drawing zones accurately is an important aspect of detailing a correct supply and demand zone. Refer to the order block slide where I demonstrated how I draw my zones from. Zoning can be subjective and requires experience and skill to accurately identify and draw zones, but with time and consistency, it will become second nature. Timing matters. Timing refers to the time of day or a trading session during which a trader chooses to enter and exit a trade based on supply and demand zones. It's important to consider the timing of trades, as liquidity and volatility can vary significantly during different trading sessions, which can impact the effectiveness of your supply and demand zones. The three major Forex trading sessions are the Asian, European and US. Each session has its own unique characteristics in terms of liquidity and volatility. In general, the European session is considered the most volatile, followed by the US, while the Asian session is usually the least volatile. It's generally recommended to avoid trading during low liquidity periods, such as the last hour of the Asian session and the first hour of the US session, as price movements can be unpredictable. It's also important to be aware of major news events and economic releases that can impact the market and cause sudden shifts in supply and demand. It's usually best to avoid trading during these times, or at least wait till the volatility has settled down and you can grasp market structure again. Discount versus premium. Supply and demand zoning. Finding the right zones. In supply and demand trading, traders can use the concept of discount and premium to identify potential buying and selling opportunities. When a currency pair is trading in a discount range, buyers may consider entering the market to take advantage of the lower price. And conversely, when a currency pair is trading at a premium, sellers may consider entering the market to take advantage of the higher price. Supply and demand zones can also be used to identify potential discount and premium pricing levels using the Fibonacci. Typically, anything around the 0.618 is considered the golden zone. It's important to note that discount and premium pricing should not be the only factor considered when making trading decisions. However, it should be used and considered as a confluence. Equilibrium. Equilibrium in the supply and demand is when the quantity demanded equals the quantity supplied, resulting in a balanced market with no inherent tendency for price or quantity to change. Now, looking at the graphic, we can now start to see what we're talking about with the point of equilibrium. So we can see we have a supply and a demand curve. And where that orange circle is, that is the point of equilibrium, which means everything is equal. And it's from this area is where we can actually identify and mark up either a premium or discount zone. And we can use this using the Fibonacci tool. So when you are marking up either low to high or high to low, you can identify whether your zone is in either a discount or premium area. And subject to whether you're buying or selling, it's going to give you a good indication of what's going on. Mistakes to avoid. Be disciplined. Things to avoid and not ignore. Misidentifying supply and demand zones. One of the biggest mistakes traders make is misidentifying supply and demand zones. This can happen if the trader does not have a clear understanding of how to draw the zones or does not take into account all of the relevant factors. Failing to wait for confirmation. Traders may enter trades too early without confirmation of a valid supply or demand zone. This can result in a loss if the price moves against the trader. Not considering confluences. Traders who trade blindly and do not have confluences are destined for failure. It is so important that when you're making a trade decision, it matches all of your confluences and it allows you to take a trade knowing that it is informed and that you have met all of your requirements for your trading strategy. Ignoring risk management. Risk management is a crucial aspect of trading that should not be ignored. Traders may risk too much on a single trade or fail to use appropriate stop loss orders to limit your losses. If you're trading without risk management, you're trading to failure, and that's a fact. And finally, allowing emotions to control your decisions. Emotions can cloud your judgment and lead to impulsive decisions that are not based on sound trading principles. As a trader, you should always follow your trading plan and check off your confluence list. Avoid making decisions on impulse because more than likely the impulsive decision will lead to a bigger loss and allowing you to then get into a cycle of chasing trades, and at this point you are now entering into a vicious cycle that you do not want to be in. Conclusions and recap. Let's talk about it. Recap of the learning objectives. We are now able to define supply and demand. We can identify key components of the supply and demand trading strategy. We can identify supply and demand zones, and we now know what mistakes to avoid. Conclusion. Supply and demand trading focuses on identifying supply, seller interest, and demand, buyer interest in areas in the market. Traders look for discounted zones, which are buying zones, and premium zones, which are selling zones, on price charts as potential turning points or areas of price continuation. By analysing supply and demand imbalances, traders aim to predict future price movements and find high probability trade setups using a full confluence list. It requires patience, discipline, and a thorough understanding of market structure. Supply and demand trading should be used in conjunction with other confluences for making well-informed decisions. Supply and demand zones can fail. This strategy does not always work. It requires backtesting, a robust rule set, and robust risk management. With consistency and not giving up, you can become profitable using this strategy. Next steps, homework time. Homework. So, building on your diary, I want you to practice drawing supply and demand zones on historical price charts for various currencies using the concepts and techniques discussed in this presentation. Analyze recent price action for a currency pair and identify any order blocks, volume spikes, and other key components of supply and demand that may have influenced the market. Then rewatch this lesson for further clarity and understanding. Remember, everything in this video is designed to give you a basic concept for you to further build on. You only get out what you put in. So if you see other items that you think are relevant to your strategy, research them, learn them, educate yourself on them. Look at other social media influencers who've done some fantastic content online. This way you can start building a sound knowledge that's coming from multiple sources, and you can start to develop your own ideology. What's next? In the next lesson, we're going to look to dive a little deeper into the concepts of trade execution and liquidity. This is a lesson you don't want to miss. References. Learning never stops. Thank you for watching. I hope you enjoyed this lesson. Don't forget to like, comment, and subscribe. I really appreciate your feedback, so please, if you have any comments, leave them down below.